Hey everybody, welcome to Banter City. Today we'll talk about debt funds as the board says. So, there's a bunch of things very few people talk about when it comes to debt funds, debt mutual funds, especially in India. So, when your mutual fund distributor tries to sell you a debt fund, what they often tell you about risks is usually credit risk and interest rate risk. But there's one more risk that usually nobody talks about in good times is the liquidity risk. Compared to equity, debt funds are extremely low in liquidity. And that's one of the reasons why Indian government came up with RBI Retail Direct to increase some liquidity in the treasury markets. Now, I don't know how well the participation was, but that was a really good idea. But when it comes to other debt funds, the liquidity is quite low, and there's also no market for junk bonds, which only makes this thing worse. At the moment, all the junk bonds, I guess, are traded usually through ARCs, asset reconstruction companies. They sell these distressed debt to some private equity funds or some hedge fund, and then they buy that, and then they try to recover as much money as they can. So typically your corporate bond mutual fund, the mutual fund containing corporate papers, or the corporate bond fund, those funds only contain AAA, AAA rated companies. The debt funds are the debt papers of AAA rated companies. So there is very little chance of default. The probability of default is low. But then when push comes to shove, there is a chance that there's definitely a non-zero chance of default. So let's just say 5% of the companies, or 5% of the bonds in that portfolio goes belly up. So the biggest trouble is when your fund manager tries to sell it, nobody wants it because that particular company has defaulted. So that really cascades this downfall for that bond. And even if the particular fund manager tries to sell that bond at some value, he would always almost have to give it away at some discount, or probably would have to side pocket it such that the NAV will drop. So that is the biggest risk of debt funds, is that because of in times of defaults due to low liquidity, or in fact they almost become illiquid, because of which they fall in a straight line, unlike equity, which can fall almost in a ramp fashion. But debt funds can fall straight down if the underlying company defaults on that bond. So that was it, folks. I know I've not explained credit and interest rate risk in detail. Obviously, liquidity risk is somewhat a part of the credit risk, because whenever there is a default, the probability of a default comes under credit risk. But again, it is generally assumed that if a company's bonds rating falls, okay, there is some drop in NAV, but the real trouble, or the whole illiquid system that we have when it comes to debt funds, and the reason is pretty simple. When it comes to equity, for example, if you're buying, say, a stock like ITC, there's just ITC, and that gets traded so many times, like millions of users trade it, so the liquidity is abundant. But when it comes to debt, even if that debt paper is issued by ITC, it is not uniform, it is not fungible. They might issue some papers, say, on March. That's a different debt bundle, that's a different debt paper, and then there's something they'll issue in September. So there is no fungibility. March debt might have been issued at say a coupon rate of 6%, whereas September debt paper might have been issued with a coupon rate of say 7.5%. So every debt issuance is different, which makes it really difficult, which makes it non-fungible, because of which these debt papers lack liquidity, and that makes debt mutual funds a risky game, because the moment credit rating drops, your NAV will drop like rocks. So that was the hidden risk of debt funds that I wanted to cover in this video. If you enjoyed this video, please subscribe to Banter City and stay tuned for more such interesting facts. Thank you.